Okay, welcome to the deep dive. This is where we really roll up our sleeves. We take source material articles, research notes, and try to boil it all down.
Distill it into the most important bits, the key insights.
Exactly. The idea is to give you a genuine shortcut to being well-informed. Hopefully, find some surprising facts, give you the context you need to really grasp what's going on.
And today, well, we've got a fascinating mission lined up. We're going to unpack some pretty major signals we're seeing in the global economy lately.
Right. Thinking about policy shifts,
Yeah.
changes in trade patterns, and what's happening with the global monetary system.
And we'll explore this mostly through the lens of insights from Adam Rosenquag of Go Ring Rosenwag, drawing from a recent interview transcript you provided.
Absolutely. It really feels like the ground is shifting, doesn't it? The whole global landscape. Understanding the forces behind that change seems, well, pretty crucial right now. So what we're really digging into here is this argument that commodity markets might be, I guess, on the verge of a really significant structural move.
Yeah. And figuring out where the potential opportunities might be hiding.
And trying to cut through the day-to-day noise, see the nuances maybe the broader market is missing.
Right. It's about looking beyond just the headlines, isn't it? Connecting those historical dots to what's unfolding right now.
Okay, let's get into it then. The source material starts off pointing to some pretty clear economic signals coming out of the U.S. recently.
Yeah, things like contracting GDP.
Consumer spending hitting a 2-year low, I think it was.
That's right. And corporate profits seeing their biggest drop since, what, 2020?
Which, on the surface, sounds pretty straightforwardly negative. Weak economy equals bad for pretty much everything.
Sure, that's the immediate take. But the core idea presented here frames these signals differently. It puts them in the context of these really long commodity cycles.
Long cycles. How long are we talking about, typically?
Historically. Often 10, maybe 15 years just to find a bottom.
15 years. Wow.
Yeah, and what's happening during those long stretches is the market is basically digesting all the excess investment and supply from the last bull run.
Okay.
And eventually, that leads to this prolonged phase where nobody wants to invest. Deep pessimism sets in.
Right. To the point where commodities just get incredibly cheap compared to financial assets, like stocks.
Exactly. And that period, that moment of maximum pessimism where there just hasn't been enough capital put back in to secure future supply, that's historically the launching pad.
The point where a new bull market tends to start.
Precisely. And the analysis in the source argues that's very much where we are right now, today.
Which is a powerful way to look at it. That today's weakness isn't the end, but maybe the bottom of the cycle, signaling a bright future for commodities, not killing them off.
Right.
And what's really compelling is how this lines up with historical patterns. The source mentioned looking back over, 150 years of commodity markets?
They did, yeah. A deep dive into bull and bear markets. And what jumped out were these recurring themes during the bear phases. Well, a major one was loads of cheap credit flooding the system, and investors getting really focused on what they call high duration, high multiple assets.
Okay, unpack that term a little. High duration, high multiple.
Sure. These are basically assets where their current price relies heavily on projecting growth and earnings way out into the future, sometimes decades out.
Okay.
Historically, that's often meant tech stocks, but different kinds in different eras, radio companies back in the 20s.
Right. Or semiconductors in the 60s.
Dot-coms in the 90s. You get the picture. And during those times, tangible stuff, commodities, they tended to get left behind.
So looking back over that 150 years, was there a consistent trigger, something that ended those commodity bear markets and started the rotation back into them?
This is where it gets really interesting. The analysis found an absolutely consistent catalyst time after time.
Which was?
A major shift in three things: trade patterns, trade policies, and the global monetary system.
And the argument is, we're potentially seeing all three of those shifting right now simultaneously.
That's the core thesis. And if that historical pattern holds, this convergence strongly suggests the long bear market for real assets, for commodities, is over.
And a new sector rotation, maybe even a new bull market, has actually begun.
That's the idea.
The source even mentioned things like that recent federal trade court ruling striking down Trump's tariffs, seeing that as part of this, tearing down the old ways.
Yeah, a piece of the old trade structure coming down. Though importantly, the analysis also pointed out, the trade war isn't necessarily finished.
Right, the current administration has other ways to influence things.
Exactly. It's less about one specific ruling and more about the broader signal, the shift in the overall approach to trade policy compared to before. These kinds of big systemic changes in trade and money, they don't happen every day. They're usually generation-defining moments.
Like the end of the 1920s, mass tariffs, the end of the classic gold standard.
Yep. Or the late 1960s, lots of post-war tariffs getting repealed, and then boom, the end of the Bretton Woods system.
And didn't it happen again in the late 90s?
It did. Big shifts, like Asian countries joining the WTO, emerging markets changing their currency pegs to the dollar.
Okay.
So these huge historical shifts, they tend to happen when real assets are really depressed, when there's a big carry trade going on in the financial system.
Hold on. Can you quickly explain carry trade in this context?
Sure. Basically, it often means borrowing money cheaply in one currency, say, where interest rates are super low, and then investing it in assets somewhere else that offer a higher return.
Okay.
When lots of big players are doing that on a massive scale, it builds up a lot of leverage, a lot of imbalances. And the source material is clear. We definitely have a large carry trade on today.
Right.
And historically, you get this situation. Depressed real assets, big carry trade, growing imbalances. Eventually, something has to give. You need a shock, a fundamental change to the system.
So that historical pattern, depressed assets, carry trade imbalances, leading to a big trade or monetary system shift. That seems to be mirroring what we see now.
It looks very similar, yeah.
So the immediate reaction, the sort of first-order thinking, might be trade tensions, weak economy, that's bad for commodities. But the second-order thinking, based on history, suggests that these exact kinds of shifts, these systemic changes, are actually the trigger for the market to rotate into commodities.
That's counterintuitive, isn't it?
It really is. But that's what the 150-year pattern seems to show.
And are there signs this rotation is actually happening now?
Yes, according to the source material. They highlighted that commodity stock sectors have actually been outperforming the broader market quite significantly.
Really?
Yeah. The data mentioned as of the day before the interview showed broad commodity stock indices up like 6, 7, even 8% year to date. Meanwhile, the S&P 500 was basically flat.
Huh. That is a clear divergence, especially with all the talk of economic weakness.
It stands out, yeah.
So if you're looking at this, where might the opportunities lie within the commodity space based on this analysis?
The advice is to focus on the areas that have been starved of capital, really starved, for a decade or more. Okay, which ones specifically?
The sectors flagged as potentially set for big moves higher are energy, gold, and uranium.
And areas maybe to be more cautious about.
Those where there has been a lot of recent investment. Lithium was mentioned, some other battery metals too.
Right.
The analysis goes so far as to suggest these favored areas, energy, gold, uranium, could potentially be the only place where investors might keep their portfolios safe and intact through, say, 2030.
Potentially the only place. That's a strong statement. It really highlights the perceived scale of this shift.
It does. It suggests a major potential dislocation.
Okay, let's dive deeper into some specifics flagged in the source. Starting with platinum group metals, PGMs, platinum, palladium. The report called them significantly mispriced. Maybe it's time to buy.
Yeah, and what's really interesting with PGMs is the common story, the bearish narrative. It's based on a real trend, right? The move away from gasoline cars, internal combustion engines, ICE vehicles.
Right, the thinking goes, no ICE, no need for catalytic converters, which is where most PGMs are used.
Exactly. To capture tailpipe emissions. Sounds logical. But the source argues that narrative has kind of gone off the rails. It's missing some key pieces.
Okay, let's unpack that. Why might this be an opportunity the market's missing? Let's start with supply.
Right. The supply side for PGMs today, according to the source, looks a lot like the uranium market did back around 2018. Just struggling.
How so?
Well, prices have been low for ages, like 15 years. Platinum, which used to trade higher than gold, is now way cheaper. Most existing producers are barely making cash, if at all, at current prices.
So no incentive to invest in new mines, right?
Absolutely zero. Why would you? The source even mentioned that a lot of people in finance don't even really know what PGMs are used for anymore. They've been out of favor for so long. And while the companies are tough, resilient, estimates suggest nearly 40% of global PGM supply is basically uneconomic right now.
Okay, so supply is really stressed. What about the demand side? That EV narrative is powerful.
It is, but it's maybe too simplistic. Look, EVs are often presented as super efficient, right? But the analysis points out making those huge batteries is incredibly energy intensive and costly.
Okay.
Now, compare that to hybrids, the cars that combine a gas engine with electric power. The source argues they're arguably much more efficient in the real world. They use a standard engine but boost its efficiency massively with just a tiny battery, like 1 or 2% the size of a full EV battery.
And crucially, hybrids do need PGMs. They have that combustion engine, need the catalytic converter.
They absolutely do. So imagine a global surge in hybrid sales. Combine that with potentially stricter emissions rules requiring more PGMs per car, higher loadings, they call it.
That could be a big demand driver the market's missing if it's only focused on pure EVs killing off ICE.
Exactly. That's the potential blind spot.
And the source mentioned investment demand coming back too.
Yeah, another possible tailwind. China, for instance, was cited as recently importing a lot of platinum specifically for investment. And it's worth noting, too, plug-in hybrids, PHEVs, they kind of muddy the waters in the data. They often get counted with pure EVs.
Right.
But they have bigger batteries than standard hybrids, maybe 10% of an EV's size. But critically, they still have a gas engine and need PGMs. And a lot of the recent EV growth outside China has actually been these PHEVs.
So the PGM story is way more complicated than just EVs win, PGMs lose. You've got stressed supply, maybe underestimated hybrid demand, tougher regulations, investment interest returning.
It paints a very different picture.
What was the suggested way to play this then? How to get exposure?
The approach discussed was owning the big PGM producers, primarily the ones in South Africa. Anglo Platinum, Impala Platinum, Sibanye-Stillwater were mentioned.
South Africa does carry its own risks, though.
Absolutely. The source acknowledged the geopolitical and operational risks there, but the thinking mirrors how they approached early uranium investments when there were hardly any new projects. You focus on getting exposure to the existing, albeit challenged, supply base.
Okay, let's shift gears slightly, but connect back to the big picture. China and the changing global monetary system. That was another key piece highlighted. China recently announced this big plan, right, to internationalize commodity markets, push for more yuan pricing in gold, oil, copper.
Yeah, and this announcement is presented as a really important symptom, evidence that a major change is already happening under the surface in the global monetary system.
Right.
The source mentioned they'd expected a monetary regime shift could be a catalyst for commodities for a while. Initially, maybe looking towards China and the BRICS nations challenging the dollar.
Okay.
Then more recently, the focus kind of shifted. Maybe the U.S. itself would make moves, the sort of jokingly called Mar-a-Lago Accords, maybe involving figures like Mnuchin or others pushing to reinforce the dollar somehow.
But China's latest move brings that BRICS angle right back into focus.
It does. But look, regardless of who triggers it, the key takeaway from the source is that the basic monetary plumbing, how money moves around the world, seems to be changing significantly compared to even just a year ago.
And that change itself is seen as a major catalyst for real assets.
That's the argument, yes. A genuinely important catalyst.
Which naturally raises the question about the U.S. dollar's dominance, if China actually starts setting prices for key commodities in yuan.
It's tempting to jump to conclusions, right, that this is the end of the dollar era, but the source offers some historical perspective here. Caution, really.
Okay.
They point out the U.S. dollar has been incredibly resilient before, even after huge shocks. The example used was the end of Bretton Woods back in the early 70s. The U.S. just unilaterally ended the gold pig on a Friday afternoon.
Right.
And the famous quote that came out of that was something like, "It's our dollar, but it's your problem." Because basically the U.S. forced the rest of the world to adapt, and ultimately the dollar actually came out stronger.
So even if the plumbing is changing, the dollar might just adapt and survive, or even thrive.
That's the possibility. It'll likely remain hugely important, maybe the dominant currency. But, and this is key, the historical resilience doesn't mean the process of change. The shock of the plumbing shifting can't still be a massive catalyst for commodities.
It's the disruption itself that matters for real assets.
Exactly, the realignment. That's the potential trigger.
Fascinating. Okay, let's pivot again. Another commodity getting a lot of buzz, uranium. Nuclear energy. We've seen uranium prices bounce back a bit, especially after Trump's executive orders supporting the sector, although some of the stocks have been, well, choppy.
Yeah, what's been interesting in uranium lately, according to the source, is how much hedge fund activity seems to have influenced things, maybe even dominated the price action over the last couple of years, kind of masking the real supply-demand picture.
How so?
Well, there was apparently a period where big funds were very long, tied into the dynamics of that Sprott physical uranium fund. Then more recently, talk of big short positions building up.
So the recent bounce in price, and in some stocks, might just be short covering, those funds having to buy back.
That seems quite likely, yes. Part of the story. Anyway, but the fundamental belief presented is that the real issue, the core bottleneck in uranium, is absolutely supply, not demand.
Okay.
And that executive order from Trump, the one aiming to fast-track small modular reactors, SMRs, by 2030, that's seen as a really significant development.
What was the key action in that order? What did it actually do?
It specifically told the Nuclear Regulatory Commission, the NRC, to get its act together, to create a new framework and actually make decisions on new reactor designs within 18 months.
Right.
The source framed this as directly tackling the huge logjam at the NRC that happened after Fukushima. It basically stopped anyone from even applying for new reactors. Only Vogtle, which was already far along, squeaked through. Another advanced design, Oklo, got denied. The whole process just stalled.
So this order is basically forcing the NRC to start approving next-gen designs, like SMRs.
That's the intent. And why is this NRC shift and the potential for SMRs seen as such a big deal? Several reasons. One, obviously, it boosts the long-term demand outlook for uranium. Two, nuclear power itself is just incredibly efficient compared to other energy sources. Way better than coal or gas, and something like 10 times more efficient than intermittent renewables like wind and solar.
And the next generation, Gen 4 reactors, are even better.
Significantly better. The source noted Gen 4 designs are expected to be roughly twice as efficient as current Gen 3 reactors.
Wow.
And because they run at lower pressure but higher temperature, they need way less concrete, steel, cement, all the stuff that makes current nuclear plants so expensive to build. That drastically cuts the cost. Plus, they're seen as much safer and produce less waste, partly because they use a different type of fuel, higher assay, low-enriched uranium.
The source even floated a really big idea connected to this, didn't they? That Gen 4 nuclear could help the U.S. deal with its national debt.
Yeah, a pretty provocative parallel was drawn. They compared it to Great Britain after the Napoleonic Wars. Britain was basically broke, facing huge debts.
Right.
But they went all in on coal. That powered the Industrial Revolution, created massive productivity gains, and they literally grew their way out of debt. The argument is Gen 4 nuclear could be the biggest efficiency leap in human history, percentage-wise. It could offer the U.S. a similar path to generate the kind of economic growth needed to handle its debt.
That's a huge potential upside.
Yeah.
How does this break down for uranium investment timing?
The source suggested thinking about it in two distinct phases.
Okay.
Phase 1 is now until roughly 2030. The analysis says the market is already super tight. Just the demand from existing reactors, plus the ones currently being built, needs more uranium than is scheduled to come online. Simple as that.
And you don't even need SMRs for this part of the forecast to work.
Nope. SMRs are irrelevant for this near-term period. Investors during this phase are expected to do well just based on that fundamental supply-demand gap.
And phase 2, after 2030.
Well, by then, more mine supply should start hitting the market. Uranium isn't actually that rare. It just takes a lot of money and time to get new mines going. So from 2030 onwards, it becomes a race. How fast does that new supply come online versus how quickly do SMRs actually get deployed? SMRs are really a 2030-plus story.
Got it. Okay, let's shift one last time back to traditional energy, oil and natural gas. On oil, the source has been warning for a while that U.S. shale is hitting its limits, that supply growth is basically done. Is that view holding?
Absolutely. And the source says this isn't just theory anymore. It's showing up in the actual data. And you're even hearing it from company executives now.
Like who?
Scott Sheffield, the former CEO of Pioneer, was cited. He apparently said point blank that one reason they sold to Exxon was they were just running out of good places to drill.
So it's not just about price fluctuations, it's geology.
That's the argument. It's geological reality. Even if oil prices shot up, the analysis suggests there isn't much more supply U.S. shale could bring online. The explosive growth phase is over. Peak shale probably happened around November 2024.
So growth is done and declines are coming.
Outright declines are expected fairly soon, and this is happening while global demand is still creeping up.
And the big energy agencies, are they catching up to this idea?
They are. The source highlighted that pretty much every major energy agency has drastically changed its long-term forecast for U.S. shale oil just in the last year.
How drastically?
A year ago, they were predicting shale growth all the way out to 2050. Now, the consensus is declines start by 2026 or 2027. Think about that. They just wiped out 27 years of expected growth in 12 months.
Wow.
Add in OPEC staying disciplined, U.S. rig counts falling. the supply side looks pretty tight for oil.
Okay, what about natural gas, particularly North American gas? The source flagged this as maybe an overlooked opportunity.
Yeah, this raises the question of what the market might be missing. The argument is that the moment for North American gas might finally be arriving, maybe in the next 6 to 12 months.
Why now?
Because the supply situation is seen as even worse than oil. North American gas supply is already down over 1.5% in the last year and likely to fall further. Most big shale gas fields, maybe except parts of the Permian, are in sustained decline now.
And yet, U.S. gas prices are still incredibly cheap compared to oil or gas elsewhere.
Dirt cheap. Canadian gas even cheaper. It's described as the cheapest energy molecule on Earth by like 70%. A massive discount to oil on an energy equivalent basis.
Why has it stayed so cheap for so long if the supply growth stopped?
Well, historically, it was that endless flood of new supply from the shale boom, right, that kept prices pinned down, but that era is over.
So why didn't prices lift sooner?
The analysis points to one main reason: 2 incredibly mild winters back-to-back. Demand just wasn't there to expose the underlying tightness.
Oh, okay.
But then last winter was more normal, and suddenly inventories, which were way above average, just collapsed into a big deficit. That showed how tight things really are now that supply is falling, and you've got new demand ramping up from data centers, LNG exports.
So what was the investment approach shared for gas?
Holding core positions in the major producers. Names like Range Resources, EQT, Antero in the U.S. were mentioned, Birchcliff in Canada.
Okay.
The view shared was, yeah, maybe they were a bit early getting into this trade, but the conviction is that the time is now. You've got low inventories, falling supply, rising demand, and these companies have really cleaned up their balance sheets.
Right.
The fundamental point is there's just no good economic reason for North American gas to be so much cheaper than gas everywhere else if supply is actually shrinking.
Okay, this paints a really strong case for being positive on commodities.
Yeah.
But what about the risks? What could derail this whole thesis? People always worry about economic growth, right?
That's the usual suspect, yeah. Weak economy equals bad for commodities.
Yeah.
But the historical analysis presented suggests that's maybe not the main thing to worry about here.
How so?
Because real asset stocks, commodity stocks, have historically shown they can completely disconnect from that conventional wisdom. They can actually do incredibly well even when the economy is terrible.
Like during the Great Depression.
Exactly. The example cited was stark. S&P 500 down 50% over the decade of the Depression. But commodity stocks, on average, they doubled.
Doubled during the Depression. That's completely counterintuitive.
It is. And it wasn't because the economy was great, obviously. It was because of that extreme underinvestment in supply before the crash, combined with other factors like the dollar being devalued against real things and costs falling for the producers.
So these stocks can be like the only thing that saves you sometimes.
Potentially, yeah, when things get really dislocated and other assets are struggling.
Okay, so if weak growth isn't the main worry for this specific thesis, what are the risks identified in the source?
The worries mentioned are more about short-term stuff, market chop and noise, just volatility, the risk of central banks making bad policy calls that mess things up temporarily, and also tail risk. The potential for something bad to happen stemming from how leveraged the financial system still is. The source felt there might actually be more systemic risk baked in today than even a year ago, despite things holding together so far.
Okay. And finally, for investors thinking about these themes, what was the recommended way to get exposure? Physical commodities, futures, stocks.
The strong advice from the source was, focus on the equities. Own the shares of the companies doing the producing. Avoid trying to invest directly in physicals or futures.
Why stay away from physicals or futures?
Mainly because of a thing called contango. It's a market structure where the price for delivering a commodity in the future is higher than the price today.
Okay. And why is that bad for investors?
Because if you're holding futures, you constantly have to sell your expiring contract and buy the next more expensive one. That difference, that roll, eats away at your returns over time, structurally. The source gave a pretty dramatic example. Over 25 years, a strategy tracking a spot commodity index using futures only captured about 25% of the actual spot price gain. You lost 3/4 of the move just to that contango effect.
Wow. But owning the stocks avoids that.
It does. In fact, a well-run producer can actually benefit from contango. They can sell their future production forward at those higher prices. So yeah, the preference is definitely equities.
And specifically,
Look for companies with good operating leverage, meaning they're efficient, their profits grow faster than sales, and crucially, avoid companies drowning in debt. heavy financial leverage. That makes them too risky. The advice was also that doing proper homework, maybe professional diligence, is probably wise given how specific these sectors can be.
Okay, well, that was certainly a deep dive. We've covered a lot of ground, the case for a major commodity cycle shift driven by these big macro and policy changes,
Looked at that sector rotation that seems to be starting, with commodity stocks leading.
and dug into specific opportunities flagged in PGMs, uranium, oil, and gas.
It really does highlight how important it is to sometimes look beyond the immediate noise, doesn't it? Understand these deeper patterns, the supply-demand details. It gives you a very different perspective.
Absolutely. A different view on the current landscape and what might be coming down the road. So thank you for joining us on this deep dive into the source material.
My pleasure.
And as we wrap up, maybe here's a final thought for you, the listener, to mull over. Given that historical link, those big shifts in trade, money, and commodity cycles always seeming to coincide, what parts of today's changing landscape will you be watching most closely?
Yeah, definitely plenty to think about there.
Indeed. Thanks for listening.